Lisa, pretty interesting moves in equity. Are you as excited about the moves in the bond markets today?
I'm always excited about the moves in the bond markets. Today, you've got the 30-year yield going down to the lowest since 2012. 10-year yield down to the lowest since May.
It's really
2013.
unbelievable that this continues, right? I mean, new lows in rates, whereas at the beginning of the year, everybody was betting on rates rising.
Well, in the U.S., you aren't seeing new lows yet, but Jeffrey Gundlach of Double Line Capital did come out over the weekend, I believe, and said if oil prices fall below $40 a barrel, prepare for some new lows for U.S. yields as well. You are seeing record low yields in Germany and France, Spain, and basically, where's the growth coming from? Where's the incentive for higher yields? Where are you going to hide if all of these austerity and stimulus measures don't work?
I thought the idea was the growth is coming from here, and we don't need any of those other people, right?
Well, that's the question, right? Can the U.S. really diverge meaningfully from the rest of the world? The manufacturing data in December cast some doubt on that. The strengthening dollar, there's potentially some benefits to that, but there are also a lot of detractions that could potentially stymie some of the growth in the orders from the U.S. You know, how can the U.S. get around the fact that oil prices are plunging? And a big reason why there has been so much growth in the U.S. has been from the energy sector, from the shale boom.
Well, even with oil prices plunging, obviously there's that shrinkage in the shale drilling. Car sales for U.S. manufacturers are going to be a lot harder with a stronger dollar when they're competing against Germans and Japanese car makers that have cheaper currencies and have easier pathways to incentives, right?
Exactly so. I mean, people are looking around. They're saying, you know what? We're seeing more risks for yields going lower, for stocks going lower. We've had high-yield bonds. We've seen credit riskier companies selling off. That's usually a leading indicator for stocks. There's not a lot of places to hide.
One of the interesting things I heard on Bloomberg Radio driving in this morning is that debt issuance in the U.S. and Europe is going to actually decline this year, whereas in emerging markets it's going to start expanding.
Well, and this is fascinating, right? Because you've seen the emerging markets debt load really increase dramatically, including hard currency debt load, meaning like U.S. dollars or euro or UK pound. And this actually creates a potential risk because it's difficult for these countries to repay their debt if their currency is depreciating
against the dollar.
This is another risk factor.
A real problem, but that's also kind of a silver lining for us.